Alright, this video explains the what we're titling the Intermediate U.S. Provision Model workbook. And this model is something that we use in the San Jose office for our space clients relatively frequently. So the purpose of this video is going to be to explain to you the template that we'll provide as a sample. Let me show you how it works. So just to orient yourself with the workbook, if you look at the bottom of the screen, you'll see that the tabs listed at the bottom, starting on the left, the first three tabs are footnote tabs. And these all are automated worksheets that pull from data that we're going to pull from other tabs in the workbook where we'll be inputting data. So these first three tabs we're not going to be inputting on per se, but they should be populating once we have some more information later in the workbook. You'll see that these first three tabs mirror what you'd expect to see in an income tax footnote, more or less in sequential order. So this first tab includes the current deferred table as well as a rate rec. There's the rate rec at the bottom. The second tab includes a deferred tax asset and deferred tax liability summary, and then the third tab is a UTB roll forward. Okay. So rather than going left to right in this workbook, I think the thing I would direct you to is the P4. And we'll come back to those interim tabs in a minute. The P4 is the current provision tab, and this is really where the input is going to start for the calculation of the tax provision. So like I did with the very basic model, I'm going to just show you a simple provision calculation, and I'm actually going to use the same exact numbers that I used in the very basic provision example, just so you can get some consistency if you're going to watch both videos. So with this schedule, unlike the very basic model, this schedule is not debit credit. This schedule is, we're going to input numbers in absolute dollar terms. Okay? So in my example, I assumed that a company had, I think we assumed they had 1,000 of income in the very basic model, but let's use millions because that'll make the footnote disclosures a bit easier. So let's start with $1 million of profit before tax. That's our PBT. The next thing we did is we had a perm item of $50,000 for meals and entertainment. Okay, so we're going to add, since this is in absolute dollars, we're going to add that back as a positive item, increasing taxable income. Okay, and just focus on this column for the moment. Think of it as a tax return where we're calculating the current tax liability. The next thing, we get down to temp items, and I think in the very basic example I used depreciation. We'll use that again. Let's say that there's an add back of $200,000. Let's say that book depreciation is $200,000, and just for ease of illustration, let's assume that tax depreciation is 0. Okay, so now we have PBT, we have a perm item, and we have a temporary item. And if we follow this schedule down to the bottom, there's our calculation of taxable income and our tax liability before credits. There's already a AMT calculation built in, but we're not going to have AMT given our assumptions. Okay, so then at the bottom here we have credits. And like with the very basic example, let's assume we have a credit. And let's assume that that credit is $20,000. Okay. One thing you might have noticed if you were paying close attention is that actually this cell pre-populated, and that is our Fin48 expense. And the theory here is that there's some percentage of that $20,000 credit we just input as a current year benefit that we think we need a Fin48 reserve for. And I'll come back to that in a second, but know that that's pulling from a Fin48 tab, but that tab actually is linking back to this credit number. Okay. So the theory is that we're going to book a 40% reserve on our R&D credit. Okay, so that column that we just input the data in, that's the best place to start from the perspective of how to get the provision going. Okay, so we've calculated our current tax liability of $417, and then we have an additional current expense of $8 for a total current provision of $425, including Fin48. Okay, so that's a pretty straightforward current liability calculation. If we go to the next tab, which is our federal deferreds, and I realize this is small, but I want to make sure you see the whole sequence of events here, sequence of the schedule. So just like any deferred tax asset and liability roll forward, this schedule is going to be a left to right roll forward of our activity. And you'll actually see that the activity in this section here, this is really all prior year balances, prior year true-ups. This right here, this is the current year activity, and so you recognize that 200,000 right where my cursor is. And then finally you'll see over in this column, this is our ending balance of deferreds. Okay? And of course, if you want different rows in the schedule, then you can customize this all you want, but you can see there's about a dozen or so pre-populated items here. Okay, so if I look at this schedule and think about which numbers are included here, you can see that the 200,000 is added as an additional build of a deferred tax asset. And that makes sense because I was saying on our current tab that we had an add back for depreciation of 200,000. So that add back is going to create a future deduction, which is a deferred tax asset. And you see that linking, if you can see the formula, it's linking straight from the P4, creating a deferred tax asset at the end of the year. Okay. I'm going to slide the screen over a little bit just so you can see what's to the right that you couldn't see on the prior screen view. Once you get to the ending balance of deferreds, there's a couple additional columns over here to separate current from non-current, and then an additional column that will allow the netting of your total current assets and your total non-current assets. Okay, so that's our deferred roll forward. So you can see that during the year, in this simple example, we had a build of our deferred tax assets of $70,000, and that's why at the end of the year we have 70,000 of DTAs. Okay. So, anyways, if you move to the next step, there's no state deferreds because we haven't input a state rate at this point. But I do want to show you the Fin48 schedule. So the Fin48 schedule is the P-7 tab. And for purposes of this template, we've cut this way down to make it simpler. But you can see that what we have here is we have in these four columns effectively a roll forward of the Fin48 items that would have been there last year, rolling it forward to get to the Fin48 balance as of the end of this year. Okay, and so in the additions column, that 8,000, that's the same number you would have seen on the P4 tab, the current tab. So that's us saying that in the current year, we're going to build $8,000 of Fin48 reserves. All right, so that's our current year build. And then notice over here in this section, what we do is we take that roll forward and we turn it into a journal entry, because we're going to book our Fin48 expense as a separate journal entry from the rest of our provision. You'll see that in a minute when we get to the Accounts tab. And so if you thought of that Fin48 build as a journal entry, you would see that there would be a credit to our Fin48 liability on the balance sheet, and there would be a debit to our expense. Okay? So that's a pretty straightforward journal entry for a Fin48 build. And you'll notice that there's quite a few other columns in this journal entry section here. So there could be activity in your Fin48 balance related to timing items or CTA or offsets for Fed benefit of state. And so the purpose of that journal entry section is to take what might seem like a relatively straightforward UTB build and make it into a complete journal entry that we can carry to the Accounts tab. So for now I'm going to keep this really simple, but I want to point out that in practice, when you have a more complicated provision, we'd expect to see some of these columns filled out with journal entries capturing all of the relevant effects. Okay, so at this point, we've computed our current provision on the P4 tab. We've check to see on our deferred roll forward that the deferreds are in fact rolling forward, and we can understand the change in balance here relative to what was on the current. And we've looked at our P-7 tab to see how we're building or reducing our UTBs year over year, and how that becomes a journal entry. Okay, so the next thing that I would go to is the P-2 tab, which is the Accounts tab. Okay, so what I'll show you about the Accounts tab is that we use, we have this tab cut in half basically, with this green line here in the middle as the dividing part. What we use this top section for up here is we have the client provide us data to explain how they got their balances from the end of last year to the end of this year. And so we want to know, how did they move their tax accounts? Forget what the real answer is based upon our provision calculation. We just want them to explain how they got their payable from the beginning of the year to the end of the year, the deferreds from the beginning of the year to the end of the year. We want to understand that that balances, so that when we ultimately recalculate it, we can come up with a journal entry that balances. Okay, so this section up here above the green bar, that's just client information. Below the green bar is us pretending that we have a blank slate and booking the provision for the year as if we could do so from scratch. And so you'll see that we didn't have to type in numbers here. These journal entries were pulling from other tabs on the schedule. So if you see the different rows, the first row here that has some numbers in it is the current provision for federal. And you'll see, just to keep our heads straight, we like to, at least some of the teams that I work with, we like to break out our tax account analysis into lots of individual components so that we're not bundling too many things together in one item. And so, for example, we book the federal current separate from the federal deferred, separate from the Fin48. And those numbers are coming from 3 different tabs, 3 different calculations, and rather than trying to bundle them into one journal entry, we're going to book those journal entries separate just so we can keep our head clear as to what's going on and what the source data is for each of those numbers. So one thing you'll find is not only in the schedule can you see the links to the different sources. So for example, this current provision, payable balance is just pulling from the provision column, but you can see the provision column is pulling from the P4, which is the actual current calc. You'll also see that throughout this model there's a lot of referencing in terms of where the data came from. So here's another reference to P4 in case you want that added documentation of where data is coming from. So I would strongly suggest building out your account analysis into these individual components, and as you customize the model for whatever your facts are, one thing I would strongly suggest is that you build out individual journal entries for things that you add. Okay, so that's our tax account analysis, and you can see that the state lines are blank here only because I've intentionally not input a state rate just to keep the illustration simple at this point. I'll add a state rate here in a few minutes. So the next thing I would go to is the, and maybe just for the moment, keep in mind that our total provision on this tab is $356,000. Okay. So the next thing I would go to is the P-1 tab, which is our rate reconciliation. And this can be a detailed rate reconciliation. You'll see on the footnote tabs we summarize it down to what we would expect to see in a 10K footnote. But this schedule will have the rate reconciliation in detail. And sometimes in our provisions, when we use this model, we blow this section out to include many rate drivers as opposed to summarizing things. So consistent with the way we use the tax account analysis, where we break things into a lot of detail, we tend to do that same thing with the rate reconciliation tab here. Okay, this one looks condensed only because our facts are really straightforward. So this tab is pulling data from various sources, and you can see the references here in terms of where information is coming from. But these are these numbers are probably going to look familiar just based upon you following along earlier as we input the P4 and P5 data. So we have a million of income, and at a 35% rate we would expect a $350,000 provision. We had one perm for meals and entertainment, and then a second perm benefit for R&D credits. And then finally we had a partial offset to that R&D credit benefit because of Fin48. Okay, and again, you can just follow where the flow of the numbers are coming from. But what I would suggest is that, again, as you, I mean, this is probably pretty obvious, but as you expand the P4 to contemplate new perms, new credits, you know, whatever it is that's driving the provision, you're going to need to correspondingly build out this rate rec for whatever those items are. Okay. So in this rate rec, our total provision is $356,000. That's the number we had on the tax account analysis, so that means the provision is working. You'll see down the right-hand side here, we label each row of the rate rec for purposes of summarizing the rate rec down below, and that's going to help us build our 10K footnote by combining items. But up here we usually have a very blown out rate rec in detail, so it's easy to follow each of the items. Then we use this legend over here to summarize things down to a more manageable level. And you'll see at the bottom of that tab there's a condensed rate rec down in this section. And all that rate rec's doing is taking the numbers at the top, it's using the letter coding down this column, and it's summarizing the amounts above into a more condensed rate rec. Okay, and then that in turn is going to flip over to the footnote tabs. Okay, so at this point, again, I have my current provision and my deferred. I've booked my entries through my tax accounts, and then I've proved my rate is working with my rate reconciliation. Okay, so what I should expect to see now, if I went to my footnote tabs, I should expect to see it's working. And again, you'd want to see that these footnote tabs include tables, just like as you'd see in a 10K footnote. So let's go through this. So we have our federal current and our deferred provision benefit, right? Because we're building DTA, so we have a credit to deferred expense. And then again is our 356 of total provision. So if we keep following this down, the second table in this tab is the rate rec. And this is pulling straight from the bottom of that P-1 schedule. So if you look at the formulas, P-1 cell C46, that's just the bottom of that rate rec tab, specifically the section that includes the summarized data. Okay, so this is our expected provision of 350, our R&D credit benefit, and then here it shows other, and that's only because we've categorized meals and entertainment as other on the P-1 tab, and you could obviously recategorize those as much as you'd like. The second tab is the Deferreds footnote tab. We have one deferred, which is fixed assets. And so you can see that's already pulling into the row for fixed assets. One of the things I've skipped over, sort of on purpose on the P-5 tab, just for the sake of time, is below the deferred roll forward, there's a mechanism to categorize the various deferreds into a condensed listing where different deferred assets and assets are bundled with others, liabilities are bundled with others to get down to that 10K condensed presentation. And lastly, we have the UTB roll forward, and this is just pulling from the activity on the P7. So if you've completed the P7 correctly and you've gotten your UTBs from last year to this year, this table ought to also update automatically. Okay, so that is the overview of the provision model. So I'm going to add a state rate assumption just so you can see how things get slightly more complicated by doing that. I'm going to add my state rate. The way I turned off the state rate was I removed from the deferred schedule for states. So I removed the apportionment percentage. So let me put in 50% here. And if I use a 50% apportionment percentage and a 10% tax rate, that will mean my provision rate is 5%. So if I go back to my current schedule, now we're going to focus on states. You can see that in general the current schedule links to federal. So it assumes that state is the same as federal, with the exception of certain obvious things such as the federal deduction for state taxes. And if there's differences between federal and state, you can just override these numbers. There's nothing sacred about these formulas. Okay, so if I follow the current count down, my 5% rate, which is pulling from that P5 deferred tab for states that I just input the apportionment percentage on, that's telling me I have a $62,500 state tax liability. And as you might have seen above, that actually pulls automatically into a federal deduction, and it assumes you're on a current method at this point. You can always adjust that to put yourself on a lag method, but the template will start with the assumption you're on a current method. Okay, so we've calculated our state current provision of 62.5, and now if we go over to the state deferred table, this looks exactly like the federal, with the one exception that the rates are different. And just like with the federal model, the current year activity is pulling from the P4 tab, just the state column this time instead of the federal column. And you can see that we are building, remember we have an add back for depreciation, so we're building a 10,000 DTA. Okay. One thing I'll point out here, in case it's not obvious, is this rate that we're using here, this rate is before Fed effect. Okay, so the model doesn't assume that we keep our deferreds net of federal effect. It assumes that we keep our state deferreds as state deferreds, and then it assumes that the federal effect of those state deferreds is in the federal deferred roll forward. Okay, so I'm going to show you that in a second. So for the moment, just keep in your head that there's a state deferred asset of $10,000, because you're going to need to know that when we get to the next tab. So if that's before federal effect and we wanted to see what the federal effect was, you would notice on this row that we have a line for federal effect of state, and remember that we were building 10,000 of state DTA, and that must mean that before the Fed tax rate we have a 10,000 taxable temporary difference in order to achieve that Fed effect. Okay, so that's what that is. And by virtue of taking that amount times the 35%, now our $10,000 of state DTA is reduced to $6,500, and that's the net of federal effect mechanics. Okay. If we go to the Accounts tab, now you can see that we have automatically populated again the rows for state taxes. So now we have both the current and the deferred journal entries for state working, and those are pulling from the P4 and P5 tabs respectively. And at this point, now you can see that the total provision, if I sum up the columns for federal expense and state expense, you can see it's 389. Okay, and that 389, if we wanted to go and to the next point, look at our P-1, our rate rec, you can see that 389 is rolling there. And the significant addition since the last time we looked at this tab was those state taxes, and you can see that that is that amount right there. Okay. And state taxes, if you follow the source of that, so the state taxes are coming from a bit of a simplified calc, but we can prove it multiple ways. This one's showing book income plus perms, which is book taxable income, times our tax rate, which is 5%, but net of the 35% Fed effect. That will calculate a state rate of 34,125. Now keep in mind, this is very simplified, so if you were to add more realistic facts to your state tax provision, you're going to have to augment this calculation, just like you'd have to augment your P4 to run, and your P5 potentially, to run additional inputs into your tax expense. Okay, but you can see how the state tax works. In theory, we have a computation of the expense. That rolls up into the rate rec. And then below, recall we were summarizing our rate rec, and that item is going to summarize itself down as its own item because state tax always is. And then off you go to the footnote tabs. Okay, and I don't think we need to spend any more time on these. You'll see these are automatically linking and updating. Okay, so what I would suggest with this, so I'll just close with a couple comments. One is, just to reiterate, P4, your current calc, that's really where the input's going to go. All the analysis really happens in P4, 5, and 7. P4 is current, P5 is deferred, P7 is Fin48. The rest of the tabs should really be summarizing, doing your analytics, putting together your footnote disclosures. Okay. The one thing I'll also mention is that when we use this provision in the San Jose office, we typically have additional tabs which I've excluded from this template and aren't necessarily turnkey, but we often include payable proof tab, all the source work papers for a provision, where's the perm coming from, the trial balance, the Fin48 support. Those will be just a series of tabs to the right of these tabs I just described, and we'll tend to package this as one workbook that includes all of the relevant data. So that's an overview of our, what we're calling our intermediate U.S. provision model.